Pascal Donoghue and Michael McGrath have unveiled Budget 2022, which they say will help Ireland recover from the pandemic, restore services and repair finances. The backdrop to this budget is one characterised by increasing public frustration over key matters such as housing, as well as mounting state debt. On top of that, the purchasing power killer, better known as inflation, is topping out at rates not seen for over a decade. Add in a ticking pension time bomb and recent international taxation changes, and you can start to see why Budget 2022 isn't your average budget. There's lots of problems that need to be addressed as soon as possible, but unfortunately it costs money to solve these problems. In this video, we're taking a look at some of the changes made in Budget 2022 and whether these changes will add real value to the lives of the Irish people and our economy. Budget 2022 contains many different policy changes across many different sectors, and so I'll be focusing on the sector changes which I'm most familiar with and on which I can voice an opinion. Before we get started, if I could ask that you take 2 seconds out of your day to leave a like on the video, and if you are new around here, don't forget to subscribe. One of the principal global issues coming into this budget was inflation. To briefly explain inflation, inflation measures the rate of rising prices of both goods and services in the economy. Some inflation is healthy and is oftentimes indicative of a growing economy. Inflation can come about due to an increase in production costs, and this is exactly what we're seeing in the construction sector, where a shortage of both materials and labour, coupled with supply chain issues and rising demand, is leading to an increase in cost. This creates further issues for the housing crisis because it becomes increasingly difficult to build affordable housing. Also contributing to the current inflation is the fact that our economy is emerging from a global pandemic. Many households have accumulated lots of idle cash over the past 18 months. The Central Bank of Ireland report that bank deposits from households stood at €134 billion at the end of August 2021, with net deposits growing by 10.9% in the past year. But with the economy now opening back up for business, there's a lot of excess demand for goods and services, which is leading to a further increase in prices. The Central Bank also reported that in August this year, for the first time since 2019, household withdrawals exceeded lodgements. Now, one of the main drawbacks associated with inflation is that the cost of living increases. We oftentimes refer to this as the purchasing power of your cash. So what has Budget 2022 done to protect the Irish people from inflation? Those receiving the state pension will receive an additional €5 per week, resulting in a maximum weekly state pension of €253.30 or €13,172 per year. This is an increase of about 2% and is meant to protect the purchasing power of the state pension income received by those currently in retirement. Nearly 33% of our workforce and close to 50% of those in the private sector rely solely on the state pension for income in retirement. But unless the government is increasing the weekly state pension payments each year, the effort to protect purchasing power is fruitless. On top of that, although increasing state pension payments might benefit those currently in retirement in the short term, it will only serve to exacerbate the Irish pension problem in the long term. The state pension as we know it is not sustainable, and with an aging demographic, we're going to have far more people relying on this already flawed system for income. Increasing state pension payments means that more money is required to fund those payments, which ultimately comes back to the taxpayer in the form of increased PRSI tax. Instead, the solution lies in private pensions and effective policy changes in that regard. Increasing the state pension in line with inflation is not a bad solution in the short term, but the government should be looking to means test the state pension in the future with an emphasis on private pension provision to replace the existing system. This will reduce the pressure on the social insurance fund, it will ensure that Irish people have a better chance at financial freedom in retirement, and ultimately it will reduce the overall tax burden on the general public. From a wages perspective, the minimum wage was increased from €10 €10.20 an hour to €10.50 an hour. This represents an increase of just under 3%, and again is designed to protect the purchasing power of the minimum wage rate from the effects of inflation. The change, coupled with the half-price travel card for under 24s, is designed for the benefit of young people. There was also a very welcome change in the form of free contraceptives for women between the ages of 17 and 25. The issue, however, is that young people are facing a much larger issue than just inflation, namely the exorbitant costs associated with rental properties. As well as this, carbon taxes and general household inflation makes living off of the minimum wage rate quite difficult. The government did, however, introduce further measures to protect workers from inflation, this time from a tax perspective. The standard rate income tax band is increasing by €1,500 to €36,800, meaning that you will pay 20% income tax right up until €36,800, after which you will pay 40% income tax on the excess. The personal, employee and earned income tax credits are all being increased by €50, which will also reduce tax bills. On top of that, the 2% USC tax band is being slightly increased in order to keep low income earners on the 2% rate for a bit longer. These changes are fine. I don't know how I feel about reducing our tax take at a time where our national debt is forecasted to be just under €240 billion, but I do accept that changes had to be introduced to account for the increased cost of living. Our tax revenues over the past 12 months have been very strong, and I assume the government are happy to pass some of the benefits of this strong performance onto the general public. But do remember that the likes of housing for all, the pandemic schemes and a ticking pension time bomb are all very costly problems to solve. What the government should be doing, in my opinion, is investing heavily in financial education. One of the best ways to protect a population from inflation is to educate them on how to battle against it. How many households had thousands in excess cash sitting in a bank account earning minimal returns because they couldn't spend it during the pandemic? What they should have done is invested that cash and started a plan for continuous investment into the future. But because accessible financial education programs are non-existent in this country, many people just don't have the information to enable them to make such decisions. Budget 2022 was very optimistic with regards to innovation. Firstly, the Employment Investment Incentive Scheme, or EIIS, is being extended for a further 3 years, and changes are being made to the scheme to make it more attractive to investors, business founders and the economy. EIIS is one of the best tax reliefs in town for investors who want to put their money in startup companies. This style of investing is of course high risk, high reward, but investors are compensated with a nice 40% tax relief on the value of the initial investment in the year of initial investment. This scheme has the potential to be very valuable to the Irish economy. The reason why is because it allows startups to give incentives to their early investors, therefore making it easier to raise money and grow the business. High potential startups are good for the economy because they create high skilled jobs, which allows people to earn a living and generates tax revenues for the exchequer. On top of this, the government are pledging €30 million to the Irish Strategic Investment Fund, which supports Irish-grown, high-innovation businesses. The introduction of a digital gaming tax credit caught my eye during Pascal Donoghue's speech. We had first heard word of the credit last year, but hadn't heard much since. The gaming sector has been growing rapidly for many years now, with the likes of Twitch becoming a very viable career path for gamers, pro tournaments having massive prize pools for competing teams, and esports organizations expanding their global reach. Pascal rightly pointed out that Ireland's employment growth in this sector has not matched the worldwide growth of the industry, leading to a missed opportunity on the part of government. The digital gaming tax credit will offer tax relief at a rate of 32% on eligible expenditure, up to a maximum limit of €25 million per project. This has a similar vibe to the research and development tax credit, which is very valuable for many companies operating in Ireland. The idea is to attract gaming companies to the country in order to create employment growth in this rapidly developing sector and allow Ireland to partake in the profitability seen by some of these companies worldwide. I very much welcome initiatives like this, especially now that Ireland has signed up to the global minimum corporate tax rate of 15%, applicable to companies earning revenues in excess of €750 million. Although I've no doubts that Ireland will remain a very competitive place for multinational companies to do business, it is reassuring to see government introduce initiatives like this to reinforce our attractiveness. Pascal made minor comments about the global minimum corporate tax rate, stating that it was in our national interest to sign the deal, albeit with the consequence of an estimated €2 billion hit per year to tax revenues. I've had a couple of questions on how an increase in tax rate can result in a reduction in tax revenues, and essentially it boils down to the other part of the deal, which will see Ireland give up some of its taxing rights over profits to larger European countries where those profits are generated. One point that was made by Pascal was that from 2023, the only borrowing by the state will be for capital spending. This is referencing the government's intention to invest heavily in housing, in line with the Housing for All plan, which was announced last month. But one of the biggest criticisms by opposition was that the budget did not deliver enough in terms of the immediate housing crisis facing both prospective buyers and renters alike. Although the budget did not include any direct measures for renters, the government did extend the rent increase limitations in rent pressure zones until the end of 2024, meaning that rent increases in these zones cannot exceed the rate of inflation. However, because we currently are facing high short-term inflation, this will likely lead to higher than normal rent increases for those in rent pressure zones. And if the renter is not in receipt of a wage which is also scaling with the rate of inflation, then this will represent a real cost. The Help to Buy scheme for first-time buyers is being extended into 2022, but likely will be subject to a review in the near future. The scheme, although a success in terms of providing greater levels of certainty for first-time buyers, has costed the Exchequer more than anticipated, 4 times more to be exact. Housing for All proposed the introduction of a new shared equity scheme in 2022, which would help buyers bridge the gap between their available deposit, as well as the mortgage they can currently obtain under macro-prudential rules, and the price of the property that they're looking to purchase. This would give the state an ownership interest in the property, while also ensuring that prospective buyers can get on the property ladder. The question is whether or not there will be a place for the Help to Buy scheme in the long term alongside the shared equity scheme. Remember that Housing for All stated that 300,000 new homes would be built by 2030. We've seen no tax increases in this budget. In fact, we've seen policy changes which will ultimately result in less cash for the Exchequer. Considering the cost of the pandemic and the state pension problem, it does beg the question as to when we're going to see tax increases in order to fund all of this spending. As I said in the Housing for All video, the plan certainly is optimistic, but ultimately it comes down to the government's ability to execute and deliver on what it has proposed. This makes Budget 2022 and all further budgets up until 2030 all the more important. Overall, I think Budget 2022 was a no-harm budget, in the sense that there was lots of small changes which are nice to haves, but they won't be solving any long-term or pervasive problems anytime soon. I think anyone who was expecting drastic changes in this budget might have been a bit unrealistic, considering the fact that we're just coming out of the pandemic and our national debt has increased significantly. However, the pressure is very much on for the government to deliver on solutions for the problems faced by the Irish people, namely housing, rising costs of living, pensions and healthcare. I would also love to see some significant investment in financial education initiatives, as I truly believe that they can solve a lot of the financial problems facing Irish citizens. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!